throughout this course. Even though it is short and it is a beginner-friendly course, it is packed with information, and if you're new to the market, you're going to learn something in every single one of these sections. Okay, so we're going to start off with the basics and talk about what are stocks. We'll talk about day trading versus swing trading versus long-term investing. We're going to go over the PDT, or the pattern day trader rule, talk about buying versus short selling and how you can make money from both stocks going up and stocks coming down. We'll get a little bit into candlestick analysis, support and resistance, market trends and trend lines. We're going to talk about different chart indicators like the RSI and the VWAP. We'll talk about the level 2 and the time and sales, which together are known as the tape. Then we'll move on to fundamental analysis and looking into a company's fundamentals, doing some research on companies for trading and investing. We'll talk about scanning the market to find the best stocks to trade every single day, no matter what trading strategy you're using. We'll talk a little bit about risk management, so that way you can keep your losses in the market small. Go over different order types like market orders, limit orders, stop loss orders. And finally, we're going to talk about the opening range breakout strategy, which again is one of my favorite trading strategies that I've used to make thousands and thousands of dollars. So if you're interested in getting started with day trading, this is the perfect course to start with. And without further ado, let's go ahead and get started right away with lesson number 1, what are stocks? Alright, so to get started, I wanted to begin with the basics here. So in this section, we're going to talk about what exactly are stocks. Now, a share of stock is going to technically represent a small amount of ownership in a company. The price of that stock is going to fluctuate based on supply, which is the selling of that stock, and the demand, which is the buying of that stock. And when there's imbalances between the supply and demand, like anything else in the world and in the economy, that's going to cause these price fluctuations in the stock market. So traders and investors like ourselves seek to profit from these price fluctuations by buying at a low price and then selling their shares at a higher price to profit the difference between where they bought and where they sold. Now, for the sake of this course, we're going to kind of break down stocks into 3 main sections. We're going to talk about small caps, mid caps, and large caps. A small cap stock is going to be shares of companies with a market capitalization between $300 million and $2 billion. Typically, these are going to be your lower price stocks, anywhere from maybe $1 a share to $5 per share. And the next step up is going to be mid-cap stocks, which are shares of companies with a market capitalization between $2 billion and $10 billion. These are going to, of course, be slightly higher priced stocks. So when someone is talking about mid-cap stocks, they're not necessarily talking about penny stocks, and they're not necessarily talking about these huge stocks, like Apple or Facebook or Tesla. Which are, of course, going to be considered large caps. And what a large cap is going to be shares of companies with a market capitalization of over $10 billion. These are also often referred to as blue chip stocks, and these are really going to be the household name companies, again, like Apple, Facebook, Tesla, Google, these very well-known and reputable companies, which, of course, are going to generally have much higher priced stocks. And I just wanted to briefly touch on these types of stocks because there are pros and cons to trading each specific type, and we're going to discuss those a little bit more throughout the rest of the course. Now, when it comes to trading and investing in stocks, there are tons of different options that you can take. Whether you're trying to very short-term trade or do some long-term investing, there are options for any type of trading preference. Obviously, the goal of this course is to focus on day trading, but I wanted to kind of differentiate day trading from swing trading, and those two also from investing. So what day trading is going to be is when you buy and sell shares within the same trading day of the same stock, with the goal being to, of course, take advantage of the very quick price fluctuations in the market. This is going to be a little bit different from what is known as swing trading, because swing trading is when you buy shares that you hold generally anywhere from a few days up to sometimes a few months before you sell that position. Of course, this is a little bit longer term than day trading, but it's not going to be quite as long-term as investing, which is typically defined as, holding positions in the stock market for a year or longer. Now, going back to what we briefly talked about just a moment ago, when it comes to small caps, mid caps, and large caps, generally speaking, day traders tend to focus a little bit more on small cap stocks, while investors will generally focus more on mid and large cap stocks. And the reason for that is because small cap stocks tend to be a little bit more volatile than mid and large cap stocks, and that volatility is what can lead to those very quick day trading profits that day traders are searching for. However, that volatility in the small market capitalization of the company itself can lead to a lot of uncertainty in the long run, which makes them a lot higher risk when it comes to long-term investing. On the other hand, swing traders and longer-term investors tend to focus more on mid and large cap stocks because these are generally going to be more reputable, financially stronger companies that are going to make better investments in the long term. Now, that's not to say that day traders can't day trade large cap stocks. The reality is that most new traders don't have a lot of money to get started with day trading, and when you're day trading large cap stocks, which have much higher priced shares, it can often require you to have a lot more money in your account in order to make any significant profits in that trade. Now, one very quick and important thing about day trading is that if you're in the United States or if you're using a brokerage that is based in the United States, you're going to unfortunately have to deal with the pattern day trader rule, which is often just referred to as the PDT rule. And what this rule does is limits the US-based traders to only placing 3 day trades per 5 business days if their account balance is below $25,000. Once your account is over $25,000, you are free to day trade as much or as little as you'd like. But until then, you do unfortunately have to go by this rule and place only 3 day trades per 5 business days. And unfortunately, this rule was put into place by the SEC in order to, quote unquote, protect inexperienced traders from placing too many trades and losing their money too quickly. But regardless of whether or not that's what it actually does, unfortunately, it is a rule that you have to follow. And if you don't, your brokerage is going to put further restrictions on your account. So a quick tip to kind of help you avoid this rule a little bit. This is perfectly legal and there's nothing wrong with this. You're able to have as many brokerage accounts as you'd like. So what I recommend doing is opening several brokerage accounts, maybe one, for example, with TD Ameritrade and one with E-Trade. And you can split your money in half, which is going to give you twice as many day trades because you're going to get 3 day trades per 5 business days in each of those brokerage accounts. On top of that, this is going to be a great way to help you get into day trading with low risk because now that your money is split up into 2 separate accounts, it's going to prevent you from putting every penny in your account into one single trade, which is a mistake that many new traders unfortunately make and often leads to some large losses. If you're enjoying this video and you want to learn more about day trading, swing trading, long-term investing, or join us in our daily interactive trading group where we provide our traders with detailed trade plans, day trade and swing trade alerts, live custom scanner streams, one-on-one support, and much more, you can learn more and get started at the first 2 links down below in the description. We're looking forward to helping you master the market and having you on the Master the Market team. One thing that a lot of new traders are not quite aware of is that you can make money in the stock market whether stocks are going up or even if they're going down. Of course, the most common way to make money in the stock market is when stocks go up. And when you're trading or investing, what you can do is buy, or in other words, quote unquote, go long in order to profit from a stock's rising price. And the way that you do that is by buying low and selling high. So if we take a look at this diagram here, the green dot representing where we would buy stock and the red dot representing where we would sell our shares, this of course would be a profitable trade because we are buying at a lower price, and then later on as the share price increases, we are selling at a higher price, giving us a profit that is going to be the difference between where we bought and where we sold, multiplied by the number of shares that we traded. And let's just say that after we bought the shares right here at this green dot, let's say that the chart ended up kind of coming down and the price fell after we bought. So we decided to cut our losses on the trade by selling at a lower price than we bought. Our loss on that trade is going to be calculated the same way. Again, it's going to be the difference between where we bought and where we sold multiplied by the number of shares. Now, on the other side of the spectrum, you can do what is known as short selling or just going short in order to profit from a stock's declining price. Now, short selling is a little bit more complex than just typical buying and selling in the stock market. So because this is a beginner-friendly course, we're going to be focusing mostly on buying. However, just to briefly cover how short selling works, first and foremost, what you would do is place an order to short sell when you believe the stock price is going to fall. Once you send out that order, what it's going to do is automatically request to borrow those shares from your brokerage. Then once those shares are lent to you from your brokerage, you would then sell those borrowed shares, later buying them back, which is called covering your short position. Ideally, this is of course going to be at a lower price. Once you cover that position, those borrowed shares are automatically going to be returned to your broker, and you are either going to profit or lose the difference between where you bought and where you sold, multiplied again by the number of shares that you traded. So if you think about it, in order to profit from short selling, you still want to buy low and sell high, the same way that you do when you're doing a typical buy and sell transaction. The difference with short selling is that you're simply selling high first, and then later on, ideally, the price is going to fall, and you're going to be able to buy back those shares at a lower price. It can be really nice and very important to understand how short selling works and to be able to utilize it in real time in the market, because stocks don't always just go straight up. They're going to have pullbacks, and they're going to have reversals to the downside. So it's important to be able to capitalize on the market in any market condition, even when stocks are going down. Moving on to candlestick analysis. Candlesticks are essentially the foundation of our charts and our technical analysis. Candlesticks are going to be made up of four main parts: an open, a high, a low, and a close. Now, if we break down these four sections of the candlestick, we can see on the left, obviously, we have a green candle, and on the right, we have a red candle. The green candle is, of course, going to be green because that simply means that it closed at a higher price than it opened for that set period of time, whereas the red candle is going to be red because that just means that while that candlestick was open, it went down and closed at a lower price than it opened. Now, the actual terms that make up these candlesticks are known as the real body, the upper wick, and the lower wick. The real body being the main colored section of the candle, and the upper wick, also sometimes called the upper shadow, is the line that's going to stick out from the top of our candlesticks, telling us the highest price that the stock or the underlying asset went during that set period of time. And of course, the lower wick is going to tell us the opposite, showing us exactly how low the price went before that candlestick closed. And all of these things are very important to understand because candlesticks can tell us a ton about a stock. Again, they are the basis of our technical analysis and the basis of our charts. So once we start talking about things like support, resistance, trend lines, different chart patterns, and getting into some more advanced trading strategies, you do have to understand candlesticks in order to understand those things as well. Okay, now depending on your chart's time frame, a candlestick can represent price action over the past 1 minute, the past 5 minutes, the past hour, the past day, and so on and so forth. Any time frame that you select on your chart is going to be what that candlestick represents. Generally speaking, short-term traders like day traders focus on short-term time frames such as the 1 minute or the 5-minute chart. Personally, as someone that day trades full-time, I would say that the 5-minute chart is the one that I focus on the most, but to each their own, and I know a lot of successful day traders that focus on the 1-minute chart, and I even know a lot of day traders that focus on longer-term charts like the 15-minute chart and still have success doing that. So that's kind of going to come down to preference, but again, generally speaking, short-term trades are going to use short-term time frames. Longer-term traders and investors are then going to focus on longer-term time frames on their charts, such as the 1 hour or the daily chart. And all of the things that we're going to talk about in the future of this course can be seen on any different time frame. So we're not just going to see levels of support and resistance on the 5-minute charts or the 1-minute charts. We're also going to see support and resistance on longer term time frames like the daily chart or the weekly chart as well. And again, the same is true for any chart patterns that we talk about in this course as well. Now, just to kind of give you an idea of how these time frames work, we have two charts here. On the left, we have the 1-minute chart, and on the right, we have the 1-day chart. Both of these were taken at the same time for the same stock, but obviously we can see that these are two very different charts. And because this is the 1-minute chart over here on the left, and this is the daily chart over here on the right, all of this price action that we see here on the 1-minute chart is fit into this one little candlestick on the daily chart. So you can see by breaking it down this way that if you're looking at the daily chart and you're planning on trying to find a day trade based on what you see on the daily chart, aside from finding any key levels of support and resistance on the daily chart, you're going to have a really tough time finding entries and exits based on the price action because it's not giving you a ton of information here on this daily chart, whereas the 1-minute chart is showing us every little price fluctuation that happens in the market, along with how much volume is coming in at that same time. And that is going to help us determine when we should get in and out of our trades, which again is why shorter term traders tend to focus on shorter term time frames like the 1-minute chart. Now, moving on from candlestick analysis, the next step that I want to talk about is going to be support and resistance. Candlesticks, again, are kind of the foundation of our charts. So in the next few sections, we're going to talk a little bit more about the chart formations and the chart patterns that we can use to actually get into trades. The next step up from candlestick analysis then is going to be support and resistance. These two things are essentially the simplest formations or quote-unquote patterns that we see in the stock market, and they tie in very closely with all other patterns that we see as well. Okay, so with that being said, what a level of support is a price level where a stock historically has a difficult time moving below due to higher amounts of buying or demand than selling or supply. At the end of the day, the stock market moves solely on supply and demand. If there's a larger amount of demand or buying at any given price level, and there's not enough sellers or supply at that price level to sustain that demand, the demand is going to push the price higher. And the opposite is true as well. So because there's a larger amount of demand at these levels of support, we typically will see that the price will rise from that support level. Now, I do want to mention before we start taking a look at some charts and some diagrams, that support levels, just like resistance levels, are not going to be 100% perfect. They're more like support areas than they are levels. So if you see that, for example, there is support forming at about $10 per share, just because the price moves down to $9.99 per share doesn't necessarily invalidate that support level just because it moved 1 penny below. Okay, now when it comes to visualizing and spotting these on your charts, it is as simple as taking a quick look at your chart and seeing where the price of the stock historically bounces off of or where the price tends to hold above. That's going to look something along the lines of what we see here with this diagram. We can see the price pulls all the way back down. At this point, because we don't know that this price action is going to happen yet, if we're watching this in real time, we don't know that this is a support level until it starts to bounce off of that area once again over here. At this point, then we can be looking to potentially buy the dip near the support level and then profit from the stock rising above it. Now, to take a real life example here, this is the chart for the stock CDIO. We're looking at the 5-minute chart, so every one of these candles is representing 5 minutes of price action, and this would be a time frame that you would most likely be watching if you're doing some short-term trading or some day trading. Now we can see pretty clearly that on this chart we do have a level of support at about $3 per share. Every time the price of the stock pulls back into that $3 level, we get a nice bounce off of it. And if you were watching this stock in real time and able to spot this level of support, you would have a great opportunity to buy into these dips down here at about $3 per share and then make a nice profit as it rebounds off of that support later in the day. It runs from just under $3 to over $3.50. So you could have made a profit of over 15% just on this one single trade within just a few hours. Now, if we take a look at the bigger picture of this chart, this is the same stock, but we're looking now at the 30-minute chart. So every one of these candles is representing 30 minutes of price action. And we can see that this Tuesday down here, this is the day that we were just looking at on a shorter term time frame. However, keeping that same level of support in mind at $3 per share, the following day we see that the stock pulls back down into that support. Once again, that level holds as support and offers a great opportunity for someone to buy into that support level. Following that, we see it's able to come up, break above the previous day's high, and it starts to run higher and higher and higher throughout the rest of the day. It actually ran from about $3 per share up to a high of $8.73 within the same day. So just by knowing where this level of support was at, there was potential to make a return of well over 100% on your investment within this one single trading day. That's why support and resistance, although they are very simple, they can be very, very beneficial to know and understand for anyone that's interested in trading or investing. Now at this point, since you should understand a little bit about how support works, resistance is essentially the polar opposite, so it should make a lot of sense to you now too. Resistance is going to be a price level where a stock historically has a difficult time moving above due to higher amounts of selling or supply than buying or demand. Again, just like support levels are not perfect, resistance levels are not perfect as well, but they can be a really good indicator that the price action is about to reverse to the downside. This is often going to look something along the lines of what we see here in this diagram. We could see that the price tops out multiple times around the same level. That level is going to be defined as an area of resistance, and we can look at that resistance area as an opportunity to short sell. Like we talked about in the previous section in buying versus short selling allows us to actually profit from a stock going down. So we could short sell into this resistance level, and then we could profit as the stock pulls back and goes lower. Alternatively, one of the things that we're going to talk about in the future of this course is going to be creating a trade plan. One of the aspects of your trade plan is going to be having an area in mind where you should lock in some of your profits. So for example, if you were to buy this down here on this pullback, you know that this recent high up here is going to be a potential area of resistance that the stock is going to pull back from. So using that level as a profit target to lock in some of your profits is a really good idea, so that way you can take profits before it starts to pull back lower. Okay, so here's an example on the 1 minute chart for SPY. SPY is the ETF for the S&P 500. This is a very commonly traded ETF, and we can see that there is quite a bit of resistance here at about $396.25. There were 1, 2, 3, 4, 5 times where the price got to that area and reversed back to the downside. So again, if you were already in a position and you were looking for an area to sell, you could look to sell into that resistance area to avoid having to hold through any future pullbacks. Alternatively, if you weren't in a position and you were looking to capitalize on this resistance level, what you could do is look to short sell into that resistance, and then you would have been able to make a really solid profit as the price started to sell off lower throughout the rest of the day. Now, one thing that a lot of new traders don't realize is that broken support can often become resistance, and broken resistance can often become support. What that means is, if we take a look at these diagrams, we can see that initially this level down here was acting as support. However, support, resistance, and anything in the stock market for that matter are not going to work 100% of the time. So occasionally, even if it looks like it's a solid level of support, the price can still break through below that. And if that happens, that past support level can then turn into a level of resistance. The same thing is true for resistance turning into support. If the stock is holding below a level of resistance and then suddenly there's a breakout above that resistance, you can actually look at that past resistance level as a newfound level of support to buy into to profit from that upward momentum. So for that reason alone, I do believe it's very important to keep track of past key levels on your charts. If there's any past significant levels of support and resistance, keep them on your charts and don't get rid of them right away, even if the price has since broken through that level. Now, moving on from support and resistance, the next step is to understand market trends and trend lines. Trend lines are essentially just slanted levels of support and resistance that can be drawn during both a market uptrend and during a market downtrend. So essentially, we're going to be using these trend lines the same way that we would with any other horizontal level of support and resistance. We can look at them as opportunities to buy the dip into trendline support and sell into the spike into trendline resistance. Now, what I mean by an uptrend or a downtrend is simply going to have to do with which direction overall the stock is moving. Obviously, even during an uptrend, there's going to be pullbacks and there's going to be dips, and vice versa. Even in a downtrend, there's going to be bounces and the stock is occasionally going to slightly recover. Okay, but what an uptrend is when the overall direction of the price is up and the stock is forming both higher highs and higher lows. Now, in an uptrend, your trend line will again act as a level of support and can be drawn on your charts by connecting the lows. If we take a look at this chart here, we can see that, again, even though the stock is overall moving to the upside, there's still these pullbacks and there's still these dips along the way. And what defines this as an uptrend is that every one of these major peaks and every one of these major dips is going to be above the previous. So right here we have our peak, we have our high. We get another peak or another high right here. Obviously, this is higher than the previous high. Same thing happens here, once again here, and a few more times up in this area. And the same thing is true for the pullbacks or the dips. We have our first major one here. We get another one here, a few in this area, and then a few more up here. Higher highs and higher lows are what define this as being in an uptrend. Okay, so once we've identified that the price is in an uptrend, the next step is going to be to draw our levels of trendline support. Again, we're just going to, in an uptrend, connect the lows in order to draw our level of trendline support. So this is what this is going to look like, and we would simply look at this as an opportunity to buy the dip into this trendline support all the way up until the point that it starts to break down below that trendline support, because at that point, there's going to be a greater chance of this switching from an uptrend into a downtrend. So once we start talking a little bit more about risk management in the future of this course, we'll cover this topic a little bit more thoroughly, but for now, just understand that if the price is breaking down below support, even if that is a level of trendline support, that is potentially a bearish signal, and that's going to be a good time to lock in your profits or potentially cut any losses on the trade in order to manage your risk. Now, just like resistance is essentially the polar opposite of support, a downtrend is essentially going to be the polar opposite of an uptrend. That means that in a downtrend, the overall direction of the price is going to be to the downside, forming both lower highs and lower lows. In a downtrend, your trend line is going to act as a level of resistance and can be drawn by connecting the highs. This is a great example of that because we see that the stock here is clearly making both lower highs and lower lows. That means that the stock is in a downtrend, and in order to draw your trend line resistance in this case, all you have to do is go ahead and connect the highs. We're going to get a line that looks something along the lines of what we see here, and we can see that every time the price tests this level of resistance, it rejects and it makes a new low. This would be a really great opportunity for short sellers because it allows you to short sell into this trend line resistance and take advantage of this downside momentum. Now, with all of that being said, the market will often trade in what is known as a price channel, which essentially means that it moves between both trendline support and trendline resistance. This is then going to give us clear levels to both buy and sell. So if we take a look here at this example of a price channel, even though the overall direction of the price is to the upside, and even though this is considered to be in an uptrend, there is definitely a level of trendline resistance that starts to form here because we can see every time the price makes a new high into this trendline resistance area, it starts to reject back down. The same is obviously true for our trendline support. Every time it pulls back into this trendline support, it bounces off of it. And because of that, this is going to be known as a price channel, and more specifically, an uptrending price channel. Now, realistically, if you wanted to, what you could do would be to buy into this trendline support, sell into trendline resistance, and then start to short sell to then actually profit as well from the pullback, and then cover into that trendline support, buy and open another position, and so on and so forth, and repeat that process until the price starts to break out of this channel. But I will say that that makes this a little bit riskier than it really needs to be, because at the end of the day, you never want to fight the trend of a stock. So if the stock is in an uptrend like we have in this example, you don't want to try to short sell the stock. You want to simply ride the momentum, and the momentum in this case is to the upside. So you would simply want to look to buy into these dips into trendline support, and then sell into the spikes into the overhead trendline resistance. So when we have these price channels in the market, it's a really great opportunity to get in and out of these quick trades for consistent small profits with very low risk. And that's one of my favorite ways to take advantage of trend lines and market trends when I'm doing my day trading. If you're enjoying this video and you want to learn more about day trading, swing trading, long-term investing, or join us in our daily interactive trading group where we provide our traders with detailed trade plans, day trade and swing trade alerts, live custom scanner streams, one-on-one support, and much more, you can learn more and get started at the first two links down below in the description. We're looking forward to helping you master the market and having you on the Master the Market team. Now in this section, I want to take a quick step back from the price action itself and focus on what are known as chart indicators. Chart indicators can be useful tools to help traders anticipate a future move in a stock. There are tons of different chart indicators that you can put onto your charts. However, I do want to say that too many indicators can cause what is known as analysis paralysis, and all that's going to do is overcomplicate things in your trading. The chart on the left side of the screen has several different moving averages. It has the VWAP, it has the on-balance volume at the bottom, and a few other indicators on there as well. All of those can be useful if you're doing a specific strategy that utilizes those indicators, but having them all on your chart at once is just going to make things much more complicated than they need to be. On the other side of the spectrum, the chart on the right side of the screen has just one indicator on, and that is the VWAP in this case, and it's going to be much more simple to analyze the price action and find better trades using just a few trading indicators at a time, like we see on the right side of the screen. Now again, as I mentioned, there are tons of different indicators, but in this section, because this is a short beginner-friendly course, we're going to just focus on two of the most commonly used trading indicators, and they also happen to be two of the ones that I think are the most valuable, especially for newer traders. Now the first of those is going to be the VWAP, or the volume weighted average price. The VWAP is calculated by totaling the dollar amount traded in every single transaction divided by the total volume. So in other words, it's essentially just a moving average that also factors in volume on top of the price, and this can be a very useful trading indicator. Now, technically speaking, the VWAP has three lines. It has an upper band, it has a middle band, and it has a lower band. However, in time, what you're probably going to notice is that most traders tend to focus solely on the middle band, and they actually take the upper and lower bands off of their charts. And that's exactly what we're going to do for this course because, again, the middle band is the one that most traders focus on, and this is the one that's going to give us the most value when it comes to our day trading. So with that being said, when you add the VWAP onto your chart, this is what it's going to look like. It is simply a line that goes throughout your chart, and it can be a very useful signal, and it can also help us to find entries and exits on our trades. So the main way that the VWAP is used is you take a look at the chart, you take a look at the VWAP, and when the price is above the VWAP, that simply indicates that the buyers are in control at the time. This means that there's more demand than there is supply for the stock. The buyers are lined up, you're probably going to see an uptrend, higher highs and higher lows. And in that case, what can happen is the VWAP will often become a level of support that we can then use to look for dip buys when the stock starts to pull back. Now, it's not always as easy as letting a stock spike up and then waiting for a dip buy when it pulls back into the VWAP, but that does happen more often than you might expect, and it is one of the many ways that traders can use the VWAP to capitalize with their day trading. Now, with that being said, if the price happens to break back under the VWAP, that can indicate that the sellers are taking control, and it may be time to sell as the VWAP can then become a level of resistance. So if we take a look at the chart at the bottom of the screen, this is a great example because we can see that there is a nice run up here briefly in the morning. The stock spikes up above the VWAP and is trending higher. So if you were watching this in real time, there's a good chance that you would be waiting for a pullback into the VWAP to actually start to buy the dip. In this case, it pulls back into VWAP, consolidates for a few minutes, and then it starts to break below VWAP. And like I mentioned earlier in the course, nothing is going to work 100% of the time in the stock market. It doesn't matter if you're a millionaire, it doesn't matter if you're a new trader. You're going to make mistakes and you're going to get into trades from time to time that seem like they're going to work out perfectly, but they end up going against you. So in this case, buying into this pullback into VWAP, there's nothing wrong with it necessarily because at this point in time, it does still seem like the stock is in an uptrend and it's simply experiencing a small pullback into VWAP support. But what happens is it starts to break below VWAP. The VWAP then turns into a bit of a resistance area, and then it starts to fade off lower and lower and lower. So that's why I wanted to mention this, because if you were to buy into this VWAP here, since it is so important to manage risk when you're trading stocks, it would be very important to take your loss and manage your risk once it starts to actually break down below the VWAP. The next chart indicator that I want to briefly cover in this section of the course is going to be the RSI, or the Relative Strength Index. The RSI is a momentum indicator used to determine when a stock is overbought or oversold. So an RSI of 30 or lower means that the stock is currently oversold, which means that it's due for a bounce in the near future. On the other side of the spectrum, an RSI of 70 or higher means that the stock is overbought and due for a pullback. And we can see by taking a look at the chart at the bottom of the screen, the RSI is actually going to be below the chart itself, and it is going to be a scale from 0 to 100, 70 being overbought, 30 being oversold, and those two levels are going to be emphasized on the RSI, so that way you can easily see when a stock becomes overbought or oversold. So in this example, we can see that initially the stock pulls back, it becomes oversold, consolidates for a while, bounces back up, it then becomes overbought, consolidates a little bit, briefly breaks above that high, pulls back down. During that pullback, it becomes oversold. Again, it bounces back up into overbought levels, kind of trades sideways and climbs higher slowly throughout the rest of the day. Okay, so it is very common for a stock to become overbought or oversold, as we can see from this example, being that it happened multiple times throughout this day alone. But one thing to keep in mind is that even though in this example, it would have worked out in your favor by buying every time the stock became oversold and selling every time the stock became overbought, it's not always going to be that simple. And because of that, I would say that the RSI on its own should not be used as a buy or sell indicator, because at the end of the day, a stock can remain overbought or oversold for an extended period of time. Instead, what you want to do is pair the RSI with the price action itself to give yourself a better odds of successfully trading with the RSI. Now, what I mean by that is taking a look at this example here. We have the same chart for Apple, and we can see that Apple becomes oversold right about here just after 12 o'clock as it pulls back under $161 per share. Okay, so if we were to buy into this position as soon as it became oversold, depending on your risk tolerance and your position size, there's a possibility that you would be stopped out almost immediately, taking a very unnecessary loss on this trade before it even has a chance to bounce out of that oversold territory. Okay, so this is where kind of pairing the price action with the RSI is going to kind of work in your favor. And what you would want to do instead is wait for it to start to bounce a little bit. And in this case, we can see that it kind of consolidates, forms a couple of higher lows and higher highs. That's a great sign that now that it is breaking out of that oversold territory, there's potential for it to kind of switch back into an uptrend. So you would realistically be better off by buying somewhere into this consolidation, maybe somewhere into this higher low, and you would have made a nice profit in doing so. But more importantly, you would have taken a lot of the guessing out of the picture because you're not buying into the stock that's just falling lower and lower and lower just because it's oversold. You're pairing that oversold indicator with the fact that the stock is actually showing signs of bottoming out and starting to reverse back to the upside. And that's very important when trading with the RSI. And realistically, that's very important when trading with any type of chart indicator. At the end of the day, the more things that you can have in your favor or in the favor of your trade, the more likely that trade is to actually work out. Level 2 and time and sales. Together, these two things are going to be referred to often as the tape. And the tape, although it is technically an indicator, it's very different from the chart indicators that we talked about in the previous section of the course when we went over the VWAP and the RSI. This is going to be a very important section because the level 2 and the time and sales are two very important indicators when it comes to price action trading, especially once you get into more advanced trading strategies down the road. Okay, so level 2 is going to be an order book that displays the price size and whether it is a buy or sell order for pretty much every single order that someone places in the market. Now, obviously, you're only going to be looking at one specific stock at a time, but with the level 2, whatever stock you're looking at, you'll be able to see where other traders are placing orders to buy or sell the stock. Now, the level 2 is really split up into two sections, which you can see at the bottom. First, we have on the left side the bids or the buyers. Obviously, when you place an order to buy or to cover a short position, that's going to appear then on the bid side or the left side of the level 2. And we can see that this is going to show the route that was used to place the order, which we're not going to pay too much attention to, followed by the price of the order. And then last but not least, the number of shares that are placed within that order. This is usually going to be by the hundred. So this is an order to buy 300 shares at $192.50. And on the other side of the level 2, then we're going to have the asks, also referred to often as the offers. And all that means is that these are the sellers. So again, every time you place an order to sell or to short sell, it's going to appear then on the right side of the level 2. Okay, so simply put, the level 2 really just allows us to visualize supply and demand at a specific price level. This can help us to identify imbalances in the supply and demand, which can of course create trade opportunities, since we know that the market really does fluctuate based on how much supply or selling and demand or buying there is at any given price. For example, if there is a 20,000 share bid or buy order placed and shown on the level 2 at $5 per share, and the offer at $5.01 is only for 500 shares, the price is likely going to rise through that 501 order. Now, that's not to say that eventually the price won't be below $5 per share, because obviously that can happen as well, but when there's a significant imbalance between the bids and the offers at any given price, short term the price is likely going to react to that imbalance. So in this case, with a 20,000 share bid, obviously that amount of demand is much greater than the 500 shares of supply, which is going to most likely temporarily drive the price above that 501 offer. Okay, so that's kind of the general idea of how the level 2 is used. However, I will say that it's going to be very important to pair the level 2 with the time and sales, and that's why these two things usually go hand in hand, because one thing that a lot of people don't understand is that some orders in the market can be placed with a hidden route that actually hides those orders from the level 2. However, no transaction can be hidden from the time and sales, So when you pair those two together, you can kind of start to see where these hidden buyers and these hidden sellers are at. Now, the time and sales is pretty self-explanatory. It's going to be a box that shows us the time, volume, price, and exchange of every transaction that happens in the market. Now again, because orders can be hidden from the level 2, but transactions cannot be hidden from the time and sales, pairing the two together can help us to spot what are known as hidden buyers and hidden sellers. Now this is a little bit more advanced, so we're not going to fully cover it here in this beginner course, but I do want to just briefly give a quick example here to touch on the topic, so that way you can really kind of just understand how the level 2 and the time and sales work together. Okay, so for example, when we're talking about hidden buyers and hidden sellers, how you would go about spotting these would be, of course, to be looking at the level 2 and the time and sales. And on the level 2, let's say, for example, it's showing that there is a bid or buy of 100 shares at $8 per share. But you see on the time and sales that there have been thousands and thousands of trades going through at $8 per share, and the same 100 share bid on the level 2 has not disappeared. That means that the order shown for 100 shares is actually a much larger order, and someone is buying up many more shares than they're actually trying to show. That's an example of how you can spot hidden buying and hidden selling using the level 2 and the time and sales. And because usually the traders that are using hidden orders are traders that are investing or trying to sell very large amounts of shares, those are the traders that we want to be aware of. So it can be very useful to know when they are doing their hidden buying or their hidden selling. Alright, now everything up until this point in this course has been related to technical analysis, which is things like chart patterns, support, resistance, candlesticks, market trends and trend lines, and really anything having to do with the price action of a stock. On the other side of the spectrum, though, you also have what is known as fundamental analysis, which is going to be the analysis of a company's financial statements, and this is going to be things like revenue, earnings per share or EPS, and operating expenses, and so on and so forth. And while these things are a little bit more important for swing traders and longer term investors who are getting into a stock for weeks, months, or even years at a time, there are still a few fundamental things that are important to look for when we're doing our day trading. And that's what we're going to cover here in this section of the course. The first fundamental aspect that's important to look into for day traders is going to be company news. One of the main ways that I trade the market is by looking for stocks that are gapping up significantly in pre-market, and then looking to either short them into weakness or looking for a gap and go setup to profit then from the momentum that carries into the market hours. We'll be talking about one of these strategies in more detail later on in the course, but for now, what you need to know is that company news can have a large effect on a stock's price, and that's often what causes these stocks to gap up. So things like earnings releases, press releases, new patents, trial results, new partnerships, and so on and so forth. All of these can cause a dramatic rise or decrease in the stock's price. So it is important to look into the company news when you see that the stock is gapping up or having a big spike to the upside. And the other fundamental aspect that I want to briefly focus on is going to be related to dilution. Dilution is when a company offers new shares into the market, diluting shareholders and raising money for the company. In other words, every stock already has a specific number of shares. That's going to be their number of shares outstanding. And what a company can do is a public offering that essentially creates more shares from thin air that they then sell into the open market, driving the price lower and lower and lower because of all of that new supply that's being brought into the market. This is obviously bad for shareholders and in the long run is going to dilute their positions. Okay, so this is definitely something that you want to look out for. These stocks that have a history of dilution are going to be less likely to hold gains when they spike up. So that's going to generally make them better short opportunities because you can many times short them into their big spike to the upside and then profit when they come crashing back down. And on the other side of the spectrum, if a company does not have a history of dilution and maybe they just release some kind of news and the stock is gapping up, that stock is going to be a great candidate for a gap and go and can very easily continue running throughout the market hours. Okay, so in order to check for dilution or a history of dilution, there's a few different websites that you can use. I'm here on bamsec.com. You can also use sec.gov. Both of them are free to use for the purpose that we're going to be doing here. And I'm going to go ahead and search a stock symbol here, GCTK. This is a stock that I know had a recent offering or recent dilution, so I want to use this just for this example. But what we're seeing here is a bunch of different filings that were put out by the company. We have financials here. These are going to be your earnings reports, both annual and quarterly. Over here, we're going to have news. These are going to be different press releases put out by the company. And what we're looking for here, when we're talking about dilution and offerings, is the prospectuses and registrations. This is going to be the important section for looking for dilution. And we can see the current date today is April 14th, 2023. So this prospectus was put out just yesterday. And if we click on that, it's going to bring us to the filing. And you can then skim through it, look into the information about the offering itself. Inside of these filings, you'll be able to see how many shares are being offered into the market, whether they are at the market price or if they're at a specific price, and how much the company plans on raising from the public offering. Okay, so I'm actually going to go back because this is a preliminary prospectus, which means that we don't get those kind of details quite yet in that offering. But just to take a look at a previous one, we can see that this is offering 8,736,198 new shares into the market. Scrolling down a bit further, we can see that at the time of this offering, there were 8,473,318 shares total. So by offering over 8 million more shares into the market, they've essentially doubled their total number of shares outstanding just from this one single offering. In other words, they added a ton of new supply with this offering, and odds are the price of the stock declined significantly from the release of this offering. Now, hopefully at this point, if you've been watching the course all the way through, you should hopefully start to feel confident enough that you can start getting into trading itself. And the first step in doing that is finding the right stocks to trade, because at the end of the day, you could have a great trading strategy, but if you're using that strategy on stocks that don't necessarily fit that strategy, you're really going to be setting yourself up for failure. So in order to find the best stocks to trade, what we're going to be doing is using a scanner. Realistically, you could be using social media, you could be using trading groups, you could even just be looking at the top percent gainers and the top percent losers for the day. Those are valid ways to go about this, especially if you're a new trader, but scanning the market and using a scanner is really going to help you find the best stocks to trade. What a scanner is a tool used by traders to find stocks meeting their pre-specified criteria. So for example, if you wanted to trade maybe stocks that were under $10 per share, that have over 1 million shares traded for the day, and that are already up 10% for the day, that would be a great way to go about finding stocks that are trending higher and have momentum. You can do just that with a scanner. And really, this is infinitely customizable. So no matter what trading strategy you use, you could find the best stocks to trade for that specific strategy. Now over here in the Thinkorswim platform from TD Ameritrade, this is a free platform to use if you have a brokerage account with TD Ameritrade. And in their platform, they have this built-in scanning software that we're going to use for this example. Okay, so let's say that we were looking for stocks that are oversold and that have potential to start bouncing back up. First, before getting into the RSI, what we're going to do is click on Add Filter, and we're going to look for stock criteria. And what we want to see is the last price was at least $1 per share and no more than $20 per share. Again, this is just an example. You can obviously adjust this based on your preferences. The next thing that we want to see is going to be volume. Volume is very important because if there is a stock that's trading very little volume, it can be difficult for your orders to get filled when you're trying to buy or sell the stock. So we want to see a minimum volume for this example of, let's say, 200,000 shares. Okay, and now the next thing that we're going to look for, if we click on Add Filter once again, we're going to go down to Study. We're going to click on the default here, go to Custom. And if we go ahead and click on the default now, what we can do is click on Study, and we can look for the RSI. Select the RSI, and we want to see that the RSI is crossing below a value of 30. And what that means is simply that the RSI within the past, let's say 3 bars, or the past 3 candlesticks in other words, has crossed below a value of 30. And going back to what we talked about in the chart indicator section, an RSI of 30 or lower is considered oversold. So these are stocks that are going to not only be between the price of $1 and $20 per share and have a minimum volume of 200,000 shares, they're also going to be stocks that have recently become oversold, giving them the potential to bounce in the near future. Now if we click on OK, we can see here by default that the 3 bars that we have selected in here with the 3 candlesticks is by default going to be on the daily time frame. But because we're looking for day trades and we're looking for these quick intraday bounces, I'm going to change this to the 5-minute chart. And then we're going to click on scan, and it's going to give us all of the results that meet that criteria. So just for example, the first one that pops up here is the stock EVER. And if we look at the chart here for EVER and we go ahead and add the RSI onto the bottom of the chart, we can see that within the past couple of candlesticks, EVER has become oversold. The current RSI is 22.967. It's also between the price of $1 and $20 per share, and the volume is over 200,000 shares for the day. Okay, so you can see hopefully how valuable it is to use these tools. And this is how I go about finding probably 95% of my trades. So I would definitely advise looking into using a scanner when you're trying to find the best stocks to trade. If you're enjoying this video and you want to learn more about day trading, swing trading, long-term investing, or join us in our daily interactive trading group where we provide our traders with detailed trade plans, day trade and swing trade alerts, live custom scanner streams, one-on-one support, and much more, you can learn more and get started at the first 2 links down below in the description. We're looking forward to helping you master the market and having you on the Master the Market team. Alright, we're now in the home stretch of this beginner course, and before we talk about one of my favorite day trading strategies in the next section, I want to first cover the different order types that you can use to actually buy and sell shares of stock. The first of those that is very important to know about is a market order. A market order is an order to buy or sell at the market's current best price. Market orders will be filled immediately as soon as you place them and may not be filled at the price that you'd prefer. Okay, so what that means is if we take a look at the level 2 down here, we of course know from talking about level 2 and time and sales in the previous section that the left side over here is going to be the bids or the buyers, and the right side over here is going to be the asks or the sellers. Now in this example, if you were to use a market order to buy 100 shares of this stock, what would happen is you would be filled at whatever the current best price is on the ask, whatever somebody is asking for their shares, as long as they have enough shares. So if this order here was for 50 shares, for example, since you place an order to buy 100 shares, you would get 50 shares filled immediately at $192.51. And then if the next lowest offer after that is all the way up at $193, your other 50 shares would not be filled until that price. Okay, so you can see how this might be dangerous if there's a stock that's maybe not trading with a ton of volume, and maybe the orders on the level 2 are pretty spaced out. Market orders in that case could cause you to get filled at a price that is going to kind of set you up for failure. Okay, so with that being said, I personally would try to avoid using market orders if possible. Only use them if you are very urgent to get in and out of a stock immediately. And ideally, you should only be trading stocks anyway that have a ton of volume, so that way you don't really have to worry about there being big spaces between the orders on the level 2. However, I will say that most of the time the better route is to use what is known as a limit order. So a limit order is going to be an order to buy or sell a stock at a specified price or better. Okay, so going back to this level 2 example here, if we were to, in this case with the stock BYND, place an order to buy 100 shares at, let's say, $192.25 per share, well, because these 2 orders here on the level 2 show the best being $192.50 and the next best after that being $192 even, our limit order would be placed in between these 2 orders, and we would only get filled on that order if the price fell down to $192.25. So this is my preferred way to trade because it allows you really to only buy or sell at the prices that you really want to buy or sell at. Taking a look at the example down here at the bottom, we can see here that between about 12:30 and 1:30 on this given day, there looks to be a little bit of support starting to form just above the VWAP here. So if you were watching that and looking for a trade in real time, instead of waiting for the stock to fall all the way back down to this level and then using a market order to try and buy very quickly as it retests this support level, what you could do is kind of in this zone here as it's trading sideways, you could simply place a limit order to buy at, maybe just below $6 per share. And that order would only be filled again once it pulls back to $6 per share or lower. So you can then just place that order and kind of sit back and forget about it until it gets filled. And if the stock doesn't pull back that far, you simply wouldn't be filled and you can cancel your order later. But in that case, there's nothing wrong with that happening either, because if it doesn't fall back to the price that you really want to buy at, there's no point in buying the stock at all. And really the same thing is true for limit orders on the sell side. If you're trying to sell out of a stock, what you could do is once you're in a position, you can look for nearby resistance levels, and you could place an order to sell your shares just below that resistance level. So that way, if the resistance hold and the stock starts to reverse back down, you've already locked in some of your profits and you don't have to worry about the stock pulling back. Okay, now the third order type that I want to talk about that is very important for risk management is going to be a stop or a stop loss order. Stop loss order is an order to buy or sell stock at the market only if the price reaches a specified price, which is known as your stop price. Okay, so what this means is, let's take the example down here at the bottom. We can see this stock is kind of trending higher. It's making higher highs and higher lows, and we have a little bit of trend line support. Now, like with any support, if a stock starts to break down below that support level, that is a bearish sign, and that can often indicate that the stock is reversing from an uptrend into a downtrend. And because of that, when a stock breaks down below support, it's usually in your best interest to manage your risk and cut losses on that trade if you're already invested into it. And that's where a stop loss order can really come into play. Okay, so let's say that you bought into this pullback here near the trendline support, and for whatever reason, maybe you didn't lock in any profits into this big spike up here. Instead of letting this crack down below support and break down even lower and take a big loss on the trade, what you could do is you could place a stop loss order with a stop price of, let's just say, $1.90 just below that trendline support. And what that would do is it would automatically sell you out of your position and cut losses on the trade for you once the stock price fell down and reached $1.90 per share. Obviously, no one wants to take a loss on a trade, but managing risk and keeping our losses small is very important with day trading. So in this case, that would be the right thing to do. And it also would have saved you a lot of money on this particular trade because, as we can see, it kind of trades sideways from that level a little bit, and then it sells all the way down to under $1.50 per share just a few hours later in the day. Okay, so simply put, stop loss orders allow you to automatically manage your risk if the stock price falls down to a specified price, which is your stop price. Now, to finally finish off this 1-hour beginner course, I want to give you a strategy that you can actually start to utilize, and it's one that I use almost every single day in my own personal trading. This strategy is known as the opening range breakout, and it can be used for both long trades as well as short trades. What an opening range breakout is when the stock price rises above or below the high or the low of the first candle of the trading day, and this is typically going to be done on the 5-minute time frame. In my opinion, this is one of the best ways to trade a stock that has a large move up in pre-market. Okay, so let's take a quick look here at this visualizer as to what this opening range breakout is going to look like. So we have our first candle here. This is at the market open, and this is on the 5-minute time frame. So this candle is going to be 5 minutes of price action. And the nice thing about this strategy is a lot of traders that are kind of new to trading, they kind of start to get anxious at the market open. They start to feel like they're going to miss out on a trade, and they kind of just blindly jump into these stocks that are moving very quickly at the market open, even when there's really no strategy to buying at that time. So with this strategy, it kind of forces you to sit back for the first 5 minutes, let that first candle completely form, and then once the second 5-minute candle opens, that's when you start to look for that opening range breakout. And once the price rises again above the high of that first candle, that's when we have technically an opening range breakout, and that's when you look to start buying into the stock's momentum, and then ideally you profit from the rise in the price that follows. Okay, so let's take a look here at this real life example here. This was a stock that I traded the other day, and it had a huge run up, and it was a really great opportunity to trade the opening range breakout strategy. So first things first, we see that here in the gray section, this is pre-market. And what we want to see again is that the stock is moving up and having a pretty big move up ideally in pre-market. And that just tells us that there is momentum there. Most of the time, if there's a big move in pre-market, there's going to be strong relative volume. There's also usually some kind of news or press release associated with that move. And what we're looking for with the opening range breakout is then kind of just validating that the momentum is still there during market hours. Okay, so if we zoom in a bit here, we can see the first 5-minute candlestick here has a high of $3.05, and it has a low down here of $2.70. So all you're doing again is looking for that breakout above that high and then starting to buy into the stock. So we get that breakout right in the second candle here. It briefly breaks above that high, and then it spikes right away all the way up to a high of $3.55. So already there was potential on that quick move there for, a 15% profit or so. But what we see happen then is it kind of consolidates above VWAP. We can see there are some long lower wicks on these candlesticks, which again, going back to the candlestick analysis section, those long lower wicks represent demand down here. Every time the stock pulls back to these levels, buyers are quickly pushing the price back up. And anyway, we can see that this breakout continues throughout pretty much the rest of the day. And it runs from that 305 breakout level at the opening range all the way up to a high later in the day of $9.73. Now, obviously, this is a great example, and they're not always going to be this big of a runner, but the opening range breakout has potential to create huge returns within just a single day. And even more important than that, if we zoom back into the opening range here, one of the reasons that I like this strategy so much is because it also gives you a clear level of risk. So with that being said, if you're buying into that breakout above the opening range high, you can then use the opening range low as your risk level to cut losses in case this breakout fails and the price starts to fall back down. So in this case, you would be risking down to a low of about $2.70 from just over $3 per share. That's about a 30 cent per share risk. And the return here